Let's continue our coverage of non-routine decisions in the short run by taking a look at special orders. A special order occurs when a customer offers something that is different than your standard or planned output. They may offer to buy a large number of units at a lower price. They may want some kind of customization, but something is different about this order. Now, we will accept this if the incremental revenues exceed the incremental costs. That's because, of course, that would result in a profit. But we have to think about costs a little bit differently. Typically, revenues and variable costs will increase, but fixed costs may or may not. It depends on if idle capacity exists. Here's our example. Toolco produces product K, which sells for $90. Cost at a production level of 10,000 units are direct material, $10, direct labor, $20, variable overhead, $15, fixed overhead allocated, $25. The full cost of production is $70. Now, this is a per unit amount of cost incurred for each unit. Toolco also incurs variable selling cost of $2 per unit in the sale of product K. A salesman submitted a special order from a new customer for 1,000 units for $60. Total fixed overhead costs are $250,000 and are allocated on the basis of units produced. Excess capacity exists, but special equipment must be rented at a cost of $3,000. Should Toolco accept the order? So let's go back and look at the information provided. We can see that this is in fact the special order. This customer wants to offer $60 per unit, and we normally sell our inventory at $90 per unit. It also costs $70 to make a unit. But let's look at these costs. First, I typically like to combine the variable cost of production because they do usually vary together. If you use materials, you're going to need labor and variable overhead. So these will combine to be $45 per unit. Now, looking at the fixed overhead, recall that we were told the total fixed overhead cost was $250,000. $25 is allocated to each unit because they allocate based on units, and there are 10,000 units. Now, we have to remember that this fixed overhead is a sunk cost. It is going to total $250,000 whether we make 10,000 units or 11,000 units with the special order. The total will be $250,000. When we do our analysis, I'm going to recognize that we do have two alternatives. We can accept this order or we can reject the order. In using incremental analysis, you would first identify what are the extra revenues that we would get under each alternative. So if we accept the order, we will receive $60 for each of the 1,000 units, or $60,000. If we reject the order, we get no extra revenue. So when we do incremental analysis, we are looking at the extra amount we will get or pay out. Next, we'll look at the extra costs we will incur. Variable costs by nature will be incurred unless you're told something that leads you to believe they will not be incurred. The variable cost of producing these 1,000 units will be $45,000 if we accept the order, and zero extra cost if we reject the order. The variable selling costs are $2 per unit. We will incur $2,000 if we accept the order, and zero if we reject the order. Now, this is one place they may have said something like a salesman was not involved in the order, and the company policy is that we do not pay sales commission on those orders. If that were stated in the problem, then perhaps this variable selling cost would not be incurred. But in the absence of something like that, you have to assume the variable cost will continue to be incurred on the extra units. Now for the fixed costs, the only additional fixed cost we're going to have is the rental of this special equipment. Because remember, the original $250,000 of fixed overhead will be incurred under either alternative. The bottom line is if we accept the order, we'll have extra income of $10,000, and if we reject the order, we'll have extra income of $0. So based on incremental analysis, we will accept the offer since income will increase. Now obviously you could omit the reject column, but again I'm trying to show you that you have two alternatives and you are looking at the difference in the two alternatives. So we've looked at the accounting side of making decisions regarding special orders, but I do want to emphasize that management has to look at the big picture, so they're going to have to ask themselves things like, does the company have the capacity to fulfill the order? If they do, fixed costs will be limited in amount, or at least the extra fixed costs that they will incur. Will the order be profitable? Can we produce the order and meet our quality standards? And will the order affect planned sales now or in the future? Sometimes when you start to discount your inventory, it becomes expected, and that results in lower sales in the future. Or on the other hand, one of your current customers might get upset about you offering a special price to one of their competitors, or just expect the same price in the future for themselves. But again, we looked at the accounting part where you will identify, will the order be profitable, and we used incremental analysis to make that decision.